This is the insane story of the violent rise and then epic blowup of Leopold Aschenbrenner's Situational Awareness Fund, where he started with about $200 million and grew it into a staggering $45 billion and then lost almost all of it in the matter of just a couple of days. And yet he is still worth billions. And if you're wondering why you should care, well, this is likely the reason why some of your favorite stocks that you are probably invested in right now had such a violent drawdown over the last couple of weeks. And then suddenly, out of nowhere, the drawdown and the bleeding stopped. So a little bit of a backstory. Leopold Aschenbrenner is a prodigy genius, probably a touch of the tism. And early on, he actually worked at FTX's future fund. And yes, it is the exact same FTX that Sam Bankman-Fried was running that blew up a couple of years ago. So it looks like this wasn't his first time around an epic unwind. After that, he actually joined OpenAI, and later he was relieved of his duty there because OpenAI accused him of improperly sharing information that he wasn't supposed to share. Shortly after he was fired from OpenAI, he released a paper, a 165-page essay called Situational Awareness, where he talked about the coming age of AI superintelligence. Just a few months later, he started a fund with the same name, Situational Awareness. Now, in this fund, he raised reportedly somewhere around $200 to $250 million from private investors, as well as larger funds like Jane Street. In line with the paper that he released of the same name, this fund was entirely focused on AI plays, and this ranged from AI infrastructure like energy plays, all the way to chip makers and data centers. But it was not like any typical hedge fund or ETF. It was highly focused and highly leveraged. Not only was he leveraged up to his eyeballs in this fund, sometimes up to 4x the amount of capital in the fund, but also he was short many companies as well in this fund. He had shorted companies that he thought were going to be the victims of the AI revolution. Companies that he was long were companies like Bloom Energy, which delivers power on site to data centers, SanDisk and other memory companies, Nvidia and other chip makers, as well as companies like IREN and other data centers like it. And then companies that he shorted massively were companies like Adobe, again, companies that he thought were going to be victims of the AI revolution. And as a result of this almost prophetic vision into the future about what the next couple of years would look like, he was able to take this fund from the $200 million it started off with to a peak of about $45 billion. That is a return of over 20,000% in a year where a good return in the overall stock market is like 20%. A 20,000% return in just a couple of years is staggering. To put that percentage into perspective, for every $1 million an investor put into this fund, they were at one point holding $200 million. Hey, real quick, if you are an active investor and your portfolio is not growing as fast as you'd like, then I would like to give you a free gift. This is something I've been working on for a long time. My team and I put together a portfolio stress test. We looked at the top 6 risks that people are exposed to in their portfolios, many times without even knowing it. And most importantly, what you can do to fix it. So we built this really cool questionnaire quiz on my website where you can input all the information about your portfolio, your investing goals, and then it's going to spit out for you a customized blueprint that shows you where you're currently at and what you need to do to get to the next level. So no matter what is holding your portfolio back and no matter what risks you're exposed to, maybe without even knowing, I want to help you find and fix your vulnerabilities, again, completely free. Once you go through this little 1-minute questionnaire on my website, it's going to send you a customized blueprint to your email, PDF you can download and you can keep it forever. And that's going to give you access to all of my courses. I've created literally hundreds of hours worth of educational content that I used to sell for hundreds, sometimes even thousands of dollars. This is now my free gift to you. You can access it 100% completely free of charge. It's going to give you all the education, all the strategies and tactics that you need in order to fix your portfolio. All you need to do is go through the questionnaire, open up the email, save that PDF, and get to work. So if you'd like to take advantage of this, all you have to do is go to my website, heresy.financial/stress test. The link is in the description below as well. It's heresy.financial/stress test. Plug in your portfolio information, and I'll send you your custom blueprint 100% free. But in the wise words of Charlie Munger, smart men go broke 3 ways: liquor, ladies, and leverage. Leopold is undoubtedly a very smart man, but for him, the L that took him down was obviously, in this case, leverage. But this was no ordinary drawdown. This was no ordinary unwinding of a leveraged position. This looked like it was a coordinated attack, so the big boys, the real big money, Wall Street could step in and pick up these positions at fire sale prices. This was as close to all-out ruthless warfare as you can get in capital markets. Now, the unwind started in Korea with the KOSPI index. Part of the reason why this unwind actually started in Korea is because their stock market is one of the most concentrated stock markets. We like to talk about the US stock market as being more concentrated than it's ever been before, but compared to the rest of the world, the US stock market is not concentrated at all. Other markets around the world are much, much more concentrated. In fact, just two stocks, Samsung Electronics and SK Hynix, account for nearly half of the entire stock market in Korea's market cap. And because these companies had been performing so well, all the traders in Korea were leveraged themselves up to their own eyeballs, making massive gains. And again, eventually that leverage has to unwind. Their stock market started to fall, and as retail traders continued to hit their margin limits and get margin called, it continued to force these companies and their overall index further down. This bled over into other areas of the market, even though some of these stocks may have not themselves had the same amount of leverage. When you are getting liquidated, you don't sell what you want, you sell what you can. When you're being margin called, you have no choice. You have to deliver the funds. This is how contagion spreads extremely rapidly through a financial system when you have so much leverage in a concentrated area being unwound at once. And this is when the sharks entered the water, because large players like Citadel realized if you can force some of the largest players like Leopold to have to forcefully unwind to liquidate what they do not want to liquidate, you will force prices extremely low. And so big money started to step in and massively increase their short interest on some of the names that Leopold was holding. You can see the short interest specifically here we're looking at for IREN, how it just exploded to well over 30% within the last couple of weeks. All this big money entering to short these positions was massive selling pressure, pushing it down, forcing margin calls on anybody who is leveraged to liquidate, pushing the stock price even lower. Now, at first, obviously, when you're in this position, you're not going to want to sell anything. And so Leopold reached out to his investors and said, hey, we need some fresh cash. This is one of the best buying opportunities right now. Everybody is getting liquidated. Prices are way lower than they will be in the future, as far as what he could tell. Said, give me more money so that we don't get margin called, so that we don't get liquidated, and we can ride this thing out. But the funds didn't come, at least not enough in enough time. And so in the final couple of days of July, he was finally forced out of his positions. And while at the peak, the fund was worth $45 billion, the fund is now reportedly only sitting on about $10 billion. Now, before you start crying for Leopold Aschenbrenner here, look at what that return still is at this point. It's still roughly a 5,000% return. Initial investment was around $200 million, sitting on $10 billion right now. That's roughly a 5,000% return. So his investors, while they did lose some from what they had before at the top, they are still making tons of money. Every $1 million invested is still currently worth about $50 million. Now, there were rumors that the fund had completely exited public markets, and the only thing that they had left over was their private investment in things like Anthropic, and that is not true. In fact, this is reportedly the letter that he just wrote to his investors, where he said, we let you down this month. We came closer to permanent capital impairment than is acceptable to us. While we did ultimately find a solution that protected the fund and you as investors, our intention is to never find ourselves in a position like this in the first place. He said, first, everything started to sell off and their long-short spreads reversed violently. He explained that as these bad moves happened, it essentially forced the bad moves to continue in a downward spiral, as everybody who was leveraged was forced to unwind. And then on Wednesday night and Thursday morning, he said, we took a decisive action to protect limited partner capital, and we traded a portion of our public portfolio in a block transaction to remove all leverage from the fund and prevent further losses. I'm going to explain because that's the big move here. This is the sharks in the water. I'll explain that in just a moment. But he said all shorts were closed and reliance on portfolio financing was removed. We currently manage a fully paid for public book long stock and long fully paid for options with no margin and no more liquidation risk. In other words, he has fully sold enough to where there is no more leverage in the fund anymore, so there can be no more forced liquidation, which is why you saw some of the stocks after he had fully exited, just the next day rally a violent 30% or so in just the course of one day. And it's that large block transaction that is the most important thing that happened here. It is because it was Citadel who bought the situational awareness portfolio in the large block transaction. What else did Citadel do just recently? Well, just a few days before the Federal Reserve's FOMC meeting, Citadel released a report saying that the Federal Reserve was actually going to hike rates. They were some of the only ones saying that the Federal Reserve was going to hike rates. What happens if the Federal Reserve does a surprise rate hike? Well, the markets are going to sell off. So whether or not they thought this was true, that certainly contributed to the overall market selling pressure that continued the downward pressure on these violent unwinds for everybody who is leveraged, getting Leopold's Situational Awareness Fund to the point where they had no choice but to sell off everything they needed in order to get out of all leverage to Citadel. And now Citadel is sitting on some massive positions at fire sale prices that are arguably much lower than the fair value of these companies, given all of the selling that has happened recently and all of the shorts that had to pile in to drive those prices lower. As those shorts close out and as the market just generally recovers, and especially as some revenues and profits start showing up in earnings, like just happened with Amazon over the last couple of days, they popped over 15% overnight from a good earnings report. Citadel is sitting on a gold mine. And so while the Situational Awareness Fund is nowhere near death, and they'll be just fine, and all the investors have still made a ton of money, and they will still continue to make a ton of money in the future. This is a cautionary tale that you just do not ever want to get in a position where somebody else can force you to liquidate. Because odds are, if you can be forced to liquidate because you've used so much leverage, the point at which you will be forced to liquidate is exactly the point at which you do not want to liquidate. It's exactly the point that would be the bottom. And the ones with dry powder to pick those things up at fire sale prices are really the ones who are going to benefit. So if you do have any of these stocks that have been performing extremely well for the last couple of months, but then over the last couple of weeks, they just started to sell off, bleed so hard you thought they were about to die, it's probably over by now. Everybody who is going to get liquidated has been liquidated. A bunch of shorts have entered the game, which means now those are all going to have to unwind. And if you are able to hold through the blood in the streets, the next couple of weeks are probably going to bring you some relief. One last note, if you're an active investor and your portfolio is not growing as fast as you'd like, my team and I put together a completely free gift for you. It's called the Portfolio Stress Test. All you have to do is answer some questions about your portfolio and your investing goals, and then it will email you a custom blueprint that will help you fix the vulnerabilities in your portfolio that you maybe didn't even know were there. It's also going to give you access to all of my courses, hundreds of hours of education, strategies, tactics on investing and trading that you need in order to fix your portfolio. Again, this is all completely free stuff I used to charge a lot of money for. Your gift free. To access it, just go to heresy.financial/stress test. The link is in the description below. Fill out the questionnaire, plug in your information. I'll send you that custom blueprint. You can get started. As always, thank you so much for watching. Have a great day.